I have, but it was for Christmas greetings, so not quite the same.
Okay, so we are live. We are live. So let's start our webinar. Hello, everyone. All our viewers here on our webinar platform, and also the ones that are watching us on YouTube right now. So if you would like to ask questions after the presentations to our speakers, so please register by the link you see in the stream description. Because we don't have comments now available in the YouTube, only on our webinar platform. So welcome to our webinar. Today we speak about SME lending and about post-COVID landscape and digitalization of SME lending. And my name is Olena Gryniuk. I will be your host today, and my guests are Helen Tunstall, Associate Director at Moody's Analytics, and Nelson Almeida, Director of Product Specialist Team at Moody's Analytics. Hello, Helen and Nelson, and welcome. Very glad to have you today.
Thank you.
Thank you very much.
Thank you.
So
nice to be here.
Before we go to the topic, let me mention very shortly organizational information. So we plan our webinar for 45 minutes. We are recording this webinar, so right after we finish, you will receive a link to the video and the presentations as well. And we will start from the presentations, and right after we'll be ready to answer all your questions. So please type your questions whenever you want, even during the presentations, and we will answer them after. So let's go to the topic of today's webinar. So all we know that during the lockdowns, we did see many banks implemented some restrictions to their credit policies in the area of SME lending. And it was a time that SMEs had to deal with the delayed payments from the counterparties and increased financial gaps by themselves. And if we talk about digitalization of SME lending, I would like to share very shortly in 1 minute what is the status quo at the moment in the Central Eastern Europe region, because we do such a study on the annual basis. And what we saw on the end of the last year, that almost from 100 banks and non-banking financial organizations that are lending to SMEs, 24% of them implemented at least online application for the SME customer. So the customer can apply either online or mobile. And only 13% of these companies have implemented fully digital process, like from their applying, from the customer applications till signing the loan agreement purely online, paperless, and also payment and repayment of the loan. So this is what we saw end of last year. Also, two criteria that I consider that still SME lending process, even if digitalized, looks a bit complicated to SMEs, is the number of the clicks. So how many clicks a customer should do first to find the online application on the bank's website. And of course, if it is a fintech, this is a non-banking financial organization, this is usually a homepage. So from a homepage, customer can click to apply online. And if it is a bank, on average 3-4 clicks are needed for a new customer to search for the online application from the bank's website. And if we go to the information that should be delivered by the customer to apply for a loan. So for a new customer, these are 28 fields in the online application that should be on average, that should be fulfilled to apply. And for existing customers in the banks that have digitalized this process, these are 16, even including the banks that have implemented invoicing systems and even can have online accounting. So having, let's say, a lot of information on the business customers, still customers are needed to fulfill this number of information of fields. So I would like to pass, Helen and Nelson, a word to you on this point, on this scope. So let us discuss this situation, the status quo, and also how this will be changing and how digitalization can help both banks and SMEs to accelerate this access to SME finance. You're welcome.
Okay, thanks, Olena. Can you hear me?
Yes.
Perfect.
Okay, just double checking. Let me just share my screen. Hang on. Sorry, trying to find the share screen button, which is not popping up at the moment. Oh, share. Can you see my screen now?
Yeah.
We can, yeah.
We can.
Okay. Okay, great. Okay, great. Good afternoon, everybody. Thank you very much for the opportunity to talk to you about lending landscape post-pandemic. Before I do that, please allow me to share a little bit of background about me. I was a banker for over 25 years. I have worked in large corporate banks in Australia and at Barclays, NatWest, Santander in the UK. I have been involved in all different areas of commercial lending, from being an asset finance officer to a credit analyst, to international trade finance specialist and senior relationship management roles. I managed portfolios from SMEs to mid-market to large international corporates with turnover of over 500 million turnover. I also worked 5 years running my own business in the creative industry, so I have some experience as a micro SME operator. I now actually look after commercial lending solutions at Moody's Analytics to help our customers reduce data entry pain points and decision times, enabling banks to spend more time with their business and commercial clients. So I hope today's session will give you some insights on lending for SMEs as we transition from the pandemic. So let me please step back a bit. Since 2008 financial crisis, the industry was already experiencing a transformation. The key forces were the regulatory and compliance requirements from central banks and sovereign regulators significantly increased. Secondly, the recession that followed 2008 kept the interest rate low. This reduced margins for the banks. As technology improved to more online services and functions were centralized, many offices and branches were closed or consolidated to reduce operating costs. Fourthly, since regulators reduced barriers to entry in 2015, we began witnessing the rise of the disruptors of the banking industry. The digital banks, neobanks, challenger banks all started to pop up all over the world. We also started seeing small business loans comparison sites, which intensify the fight for market share. The introduction of open banking to improve better services from banks to customers also increased competition and grow customers. As you can see, the lending landscape was already under pressure from increased costs and competition, as well as digital transformation. Then came COVID. All of a sudden, social distance and remote working requirements made online services and communicating with customers digitally became essential. It wasn't an option anymore. The pandemic intensified the forces for change and accelerated the need for digital transformation that we were already seeing from pre-pandemic. We also witnessed new SME products. Banks needed to accommodate for new lending products that were linked to government support schemes. For challenger banks, which many started with personal products and payment solutions for business customers, it evolved to expanding the basic terms term loans and overdrafts for SMEs. Many of these banks also introduced government support loans to businesses as a mode of growing their market share. All these forces were creating better services for the customers, but more competition for the SME lenders. On the other side of the equation, the pandemic sought through the SMEs that were able to sustain the downturn and remain creditworthy from those that weren't. As we journey through from the pandemic, what are the trends and challenges which are impacting this SME lenders now? Firstly, the KYC and onboarding rules are ever changing and becoming more onerous. This is further exacerbated by the war in Ukraine, with additional sanctions and due diligence in place. With digital transformation comes with additional cybercrimes, so the banks need to now grow their books in a safer manner. Secondly, information gathering for financials, creditworthiness from SME customers for many banks are still very manual and time-consuming. Thirdly, which I guess a lot of the traditional banks are still very much suffering, are the legacy systems. They are still in place where none of the platforms are integrated and requires the relationship manager or business manager to data entry the same information in multiple times in several platforms. Just last week, I spoke to a business bank manager for SME customer for a large bank. I asked him about the workflow, expecting COVID might have encouraged the lending workflow to be streamlined. However, this wasn't the case. He mentioned to put a credit proposal together for a small business loan. Him and his associate required data entry to over 40 different platforms, and none of them talked to each other. The decision time took over 5 weeks for a small business loan and was unable to guarantee decision within appropriate time for an SME who was trying to buy a commercial property. Over the last few months, we've been engaged in discussions with several traditional banks across Europe, Africa, Middle East, and Asia, sharing exactly the same pain points to the lending workflow. It seems the manual process is becoming more difficult to sustain to remain competitive in the market. Conversely, challenger banks are not burdened with legacy systems, and they have a small number of products. So they are already user-friendly with fast decision time process. We have been involved with helping challenger banks to help their decisioning process go faster. Recently, we implemented a lending platform for a digital bank in Singapore, and their time to yes was submitting the application for a loan decision was within 24 hours. Climate is also a key force in the lending workflow, especially to the SMEs who will be more vulnerable to climate risks. As regulators' requirements and bank strategy shift its focus on sustainability, physical and transitional risks to the borrowing entities are becoming important factors to address and mitigate. Banks are looking at how to measure these risks, addressing the climate as the 6th C to credit without adding more manual steps to process. And lastly, a recent survey from banks in Europe, 17% of the participants expect insolvencies and impaired loans following the pandemic to increase. The inflationary supply chain and cost of living challenges is also expected to add further pressures to delinquency levels. Against this landscape, 70% of recent survey of the banks indicated that the leveraging data and analytics and technology to build market share for SME is the key. They're looking for seamless onboarding and KYC process that's user-friendly to its customers and internal stakeholders. Customer retention and increasing market share is the key. Automate data entry to reduce manual and labor-intensive tasks. Time to decision and funding to be improved. and enhance customer satisfaction and customer centricity. So where do we go from here? As we shift focus from pandemic to new challenges, opportunities for SME lenders to remain resilient can be found by integrating of tools to automate gathering of information and structuring of lending facilities from financial statements, tax returns, and other documents to meet regulatory and compliance requirements. More and more banks, both traditional and new banks, are developing new types of loans to facilitate renewable and greener activities and move away from those that are negatively impacting the environment and grow a more sustainable loan book. So incorporating objective measures to climate risk in decision process for SMEs will help lenders remain competitive and protect the bank's risk appetite. Streamlining process and decisions and workflow functionality to track lending tasks and requirements for faster decisioning, and enhance early warning, portfolio monitoring, and business intelligence capabilities to have a deeper understanding of borrowers and spot those distressed loans earlier. This is something that we are witnessing a lot of banks are prioritizing in recent months, in particular with the current inflationary pressures, cost of living, energy prices, and supply chain challenges, which all impact on the resilience of the SME customers. So hopefully that gives you a very good overview in a very broad overview of the lending landscape of today that we are seeing from SME lenders. Thanks very much for your time today. I hope this has been interesting and the topic I have mentioned has resonated with many of you. And now I'll hand you over to Olena and Nelson.
Nelson, are you with us?
Yes, we are. Let me share my screen. Get myself ready to go. And there we go. Able to see that okay? Okay. Able to see the screen okay there?
Yep.
Perfect. Okay, quick introduction. I'm Nelson Almeida. I'm a solution specialist with Moody's Analytics. I've covered various components of credit risk and the process and credit decisioning process for various financial institutions. I've been doing it for well over a decade. I've covered organizations from Kazakhstan to Finland to South Africa. I cover quite a broad and have covered quite a broad geographic region, everything from large corporates all the way down to small emerging markets organizations in terms of the ability to do lending, whether it's a local organization in terms of a local bank or financial institution, all the way up to some of the largest institutions in the world. I've been fortunate enough to be able to cover a vast array of countries, and that's kind of helped me in terms of being able to see from many perspectives the process of this lending. And of course, with the advent of COVID, this has obviously placed new pressures on organizations, on not just from the banking sector, but also on the SMEs themselves. And I'm happy to say we've had our first trip, which was quite an event for the last 2 years, which is rather nice, and getting to see customers again. A quick breakdown of who we are. So we work for Moody's Analytics. We cover quite a number of different areas in terms of our portfolio. Obviously, the one that we're going to be talking about today are the commercial lending, predictive analytics, KYC, know your customer, and anti-money laundering, climate risk, and regulatory compliance and the like. We're a component of the Moody's Corporation, a separate entity that specializes in things like credit risk. And you've probably come across us in your dealings in the credit world. So first things first, let's have a look at an SME? The definition is quite broad. We look at the European definition for SMEs in terms of the organizations. Obviously, the first one being its private ownership. But you have three distinct, if you like, layers to the SME side. So micro, small, and medium. Now, the way you deal with these organizations obviously is going to be quite different in that your micro SMEs, obviously your much smaller organizations under 2 million euros, less than 10 headcount, they're going to be more related to your retail banking arena than your larger medium-sized SMEs that are looking at quite a large staff headcount in terms of 250 and got a balance sheet total going over 43 million, or in this case 50 million turnover. So they're quite different organizations that incorporate under that SME definition, and how you deal with them obviously differs. In terms of the micro, because it's closer to the retail, they tend to be more cookie cutter. You want to be able to give them standardized capabilities. You want to have standardized facilities to offer them, and obviously process it as quickly as possible. Whereas your medium organizations are much larger entities, could be part of a group, and you're dealing with them in a slightly different way in terms of the amount of the facilities that you offer, but also what you offer them is going to change, and how you offer them is going to change. We saw those interesting slides earlier about the online presence, the technology presence of organizations, being able to see that from the micro, but also the medium size enterprises, how that is going to differ. And we all know that the SMEs account for a vast part of most countries' economic activity, as we can see from the UK, but some statistics around the UK, looking at, it accounts for a large chunk of total number of businesses, but also a large chunk of employment, as well as GDP. So these are very important organizations. And of course, post-COVID, the pressure to digitalize, the pressure on both the SMEs, but also on people that are providing tools for SMEs in terms of credit tools and the like, these pressures have intensified some of the existing issues and have created some of their own. So let's have a quick look at the way we can see these in terms of from a lending perspective, how people are looking at it from the point of view of how you can process these items. So the first item you've got is, if we look at our graph at the bottom here, down the bottom here, we've got SMEs. As we've pointed out, especially the smaller SMEs, you're going to want to be able to process it quickly. You're going to want to be able to process it without much human intervention. Naturally, in terms of the complexity of the organization, they tend to be quite simple. Therefore, speed and ease of use is the most important part of this. As we start to get larger, and this can also count within the SME definition, if you look at your top end of your SMEs going into the middle market, your process becomes more complex. Your touch points with the organization are more complex. The data that you can acquire is better, whereas your micro SMEs the data tends to be less available. It depends on the country that you're in. If there is availability of this in certain jurisdictions, you've got good quality small SME data, whereas in other definitions that is either not as good or non-existent at all, and that's then up to the lender to be able to make use of that. And how you deal with that becomes part of one of the capabilities that you can offer in that respect. So as they get larger, your business becomes more complex. Your interactions with the organization become more complex, and now you need the systems to be able to support that, both from the point of view of the automated system where you've digitized, where your clients are interacting with your organization from a digital point of view, and we saw the percentages there from the point of view of the Eastern European percentages in terms of organizations that have digitized their systems. And this has become even more important from the point of view of the post-COVID situation that we find ourselves in, both from the point of view of being able to interact with your clients, but also the pressures that are being put on lending institutions to manage it. Now, the hybrid scenario is where you are dealing with your organizations. You may have certain processes in terms of the credit decisioning and time to money and time to decision that you want to standardize, but other processes you want to make use of your internal working processes. So the idea is to get away from those Excel spreadsheets if you can, and get this as organized as possible and have the underlying technology to be able to do that. Naturally, for organizations that are existing organizations, larger organizations, this becomes more difficult because you do have the situation of legacy systems, and these can be quite substantial. The cost of replacing them, the cost of moving on from them or even integrating into them becomes quite substantial. Whereas your fintechs, your challenger banks, as they're termed, or lending-like institutions, they tend to, because they don't have that legacy situation, it makes it easier for them to be able to be much more flexible and to design the system specifically to their requirements without the issues of legacy. This brings its own issues for clients. And that while they're more flexible, certainly, this becomes more of an issue in that what you're trying to cover, you're not able to offer a wider range of services, and you're very specific in terms of the services you can provide. So let's have a look at some of the challenges. Obviously, the first one being financial information, but not just financial information about the client, the KYC, as mentioned, with the issues taking place with recently with the in Ukraine, for example. This is creating more stresses for it. So the ability to get that information and to have enough information about their client to be able to make a quick decision, that's very important. Now, this is also both from the point of view of new clients, but also existing clients. Being able to predict the cash flows of the client. Are they going to be able to provide that to you? Especially the micro, you tend to be looking more at the behavioral side in terms of the behavior, in terms of their accounts, for example. But also as we get larger, you're now starting to get income statement and balance sheets that you want to be able to see both from what the client has provided you, but also derive from that income statement and balance sheet to actually see your own view on it. Rating models are key to be able to, both from the point of view of rating the client from a credit risk perspective, but also from the point of view of decisioning. So underlying model itself is only as good as the data that it was built on. So the ability to get that data and the ability to use that data becomes a key challenge, especially in this post-COVID era where we've been through, if you want to be able to represent that kind of information and all the events that's taken place over the last 2 or 3 years, to incorporate that into your thinking and also into your models themselves. Volume. Smaller SMEs, naturally, large volume. You have to have the systems to support that. Obviously, digitization allows you to do that. Having it on a website or on the phone allows much greater volume to be had and also more efficiently handled by the organization. But as this only is not only from the point of view of being able to take on clients and take on new clients or service your existing clients, but things like further down problem loan management. With COVID, potentially the increase in problem loans, and this is one of the functions that they obviously have to be aware of if you're looking forward, to be able to manage that to the best of your ability, and to also, from the point of view of your portfolio, to be able to manage that as the portfolio that you've created. Data reporting and audit requirements, importantly, regulatory requirements that are being placed on the SMEs, both from the point of view of COVID as governments and regulators grapple with the after effects of COVID and how to handle it, and potentially how to manage that risk appetite, if you like, to promote lending to SMEs, but also to not, with the stresses that we have as regarding inflation. This all has to be managed together. And the only way to do that is from the point of view of data, from the point of view of how you're going to be lending. That helps you make better decisions. And to capture that data is a tricky part. If you've got access to it perfectly, but if you don't, how are you going to capture it and how are you going to make informed decisions on it? How sustainable is the client? You're forwarding credit instruments for it and credit facilities for the client. How sustainable are they? And this also becomes a question in terms of problem loan management. How sustainable are they? Do the volume that you're going to create with this is also something that you need to look at. So these are some of the key challenges that we're looking at from the SME lending point of view. Some pain points, as I mentioned: information gathering, where you're going to get this data from, what type of data do you have, credit assessment, your models. Let's get away from those Excel-based spreadsheets. Often that can be a problem in itself. You want to be able to plug in easily into your process. Simplified loans, obviously from the micro organizations, micro SMEs, the products you're going to be offering them are relatively straightforward. However, the larger organizations, also under the SME banner, your products will get more sophisticated in terms of what you're offering and the ability to service both of those cases. A number of these others, each one with their own different pain point. I'm not going to go through every single one. We wouldn't have time to mention each one of them. But the point of it is that the actual process itself, in terms of their credit decisioning, but also in terms of time to money and time to decision, there's a number of items here that highlight some of the issues that you're facing. Slightly different depending if you're an existing organization or one of the fintechs or one of the challenger banks in that case. issues might be slightly different in terms of the challenger banks versus the legacy organizations in terms of how they approach it and how they can interact in terms of both providing the credit products from their point of view, but also complement each other in terms of the market itself. Opportunities. So not only is it, it's been the issues that we faced with the post-COVID, some of the opportunities for SME lenders. So non-traditional data is opening up a whole new area for organizations in terms of getting to know your clients better, what to offer your clients, but also from the credit perspective, new areas are being opened up from the credit perspective, things like social media, for example. That all adds into your knowledge of your client, but from the credit point of view, but also from what offers you're going to offer the client or what kind of products you're going to offer the client, and be able to identify your clients better and give you better, as was mentioned earlier. The forward-looking predictive analytics are becoming more and more important to organizations because of the intensification of the COVID legacy. So where clients are getting themselves into trouble, you want to be able to react quicker to that. With the SMEs, you've got to have the volume to be able to do that. Technology is a big differentiator. It's not just a case of the relationship anymore. The technology that's being offered to clients, whether it's via your mobile banking application, whether it's online, the options are now becoming much, much greater. And we've seen around the world how different regions have approached the technology piece. So a great example of this, if you look at some of the African countries, where they never had the infrastructure in terms of base infrastructure, in terms of your internet-based infrastructure was never there. So they actually jumped straight to mobile phones. So they were very early adopters of that mobile phone technology. If we look back probably 5 or 8 years, they were very early adopters for their mobile phone technology to be able to do payments online, banking online, things like that. Very, very early adopters because of the fact was they were forced into it because they didn't have the infrastructure to support it. So this is where that digital engagement becomes mandatory. You have to engage digitally with your clients, both from the point of view of things like banking apps, but also from the point of view of things like websites and all of the good practice that's around it. So the good practice would be very few clicks, being able to do it quickly, easily from a client point of view. Also, how are you engaging with them? A micro SME versus a large SME, the engagement model is going to be quite different in terms of how you want to engage with them. And that's something which has to be taken into consideration. For the existing organizations, or existing banks and existing financial institutions, one of the benefits that they have where they may be at a disadvantage from the fintechs in terms of the ability to how easily fintechs are able to, the ability to respond to market, the ability to provide application, to be flexible in terms of that. One of the big areas and advantages they have is a service diversification. They're not tied into just that one single offering that they can provide. They can actually provide other offerings. And sometimes this can be complementary in terms of the offerings that they can provide, both from the point of view of the fintech, working with existing institutions, but also the diversity of product that can be offered from the more traditional banking institutions. So it can be both from a point of view at a disadvantage, but it can also have a advantage for those existing institutions. And in some cases, this can be complementary in terms of how they operate in the market. SME lending opportunities, much like I've said before, if we look at the negatives that we have, the ability to capture that data, the ability to use that data, and also the fine tuning and volume that you want to get in terms of the client. Some areas from our point of view that we can see in specific areas in terms of gathering data, things like automated financial spreading, the ability to get financial data in. So if you're looking at not necessarily your micro SMEs where they're more behavioral based in terms of their behavior and their account behavior, you're looking at your larger SMEs where they do have financial statements, income statement, balance sheet, and the like. The ability to take things like PDFs, things like Excel spreadsheets and the like, and Word documents, and making use of some of the emerging technologies, in this case, AI-based rules, to increase the speed at which you process, but also the accuracy at which you process. So what we're looking at doing, and that's what's laid out here, is the ability to take that financial data that clients can provide, whether it's on an online portal, as we saw with the clients having online portals, being able to upload their financial statements, being able to read it, apply it, and then have it ready to be used internally to fine-tune that acquisition of financial data. These tools that you see, this item that you see here, with the machine learning supplemented by human experts, ideal. You're not totally relying on the AI piece, because the AI piece you want to have a human interaction in this, because ultimately the decisions, you need to have a human component to it. But the important part about this is you gain both speed and accuracy in terms of supplementing it with the AI tools. Another part to this in terms of the ability to take a balance sheet, PDF documents, upload that, get the table identification in terms of the process we have, and then to make that available, not just, in this case, we're just looking at English, but also make it available in other languages. And the ability to move between those languages and provide new languages is quite important, because you can cover, especially in Europe, where you've got a large number of different languages that are required. The ability to do that is something which becomes quite key if you want to operate in different markets. Great example. On the left-hand side, you have your interpreted financials. On the right-hand side is the actual PDF, being able to see it easily, being able to present it easily to the person using it, but also that it's available to be used. And ideally, what you want to do from the point of view of your SME type clients, if you want to digitize with your SME type clients, especially the smaller clients, management by exception. Let the system handle it, let the system run through. But when there's an issue or it needs to be overseen by someone, let the system highlight that and say, hang on a sec, there is an issue here, let's bring a person into it. As we get larger, looking at from the micro to the large SMEs, that type of interaction there'll be more interaction with the human, less interaction with the machine. Obviously, from the human point of view, is going to be dealing with the client. But this is a great way to get those financials in, to automate that financial. So the client provides you with the data, uploads it, or provides it to the relationship manager or in branch, for example. Get it there, get it ready, and also verify that data. Because one of the issues that I've come across with clients is the financials that are provided, especially with the smaller SMEs, can be of varying quality. A quick way to check it. Upload it. Does this even make sense? In that case, it's a great way to be able to do that, get the machine to do that and go, right, these financials make sense. Let's carry on. Great way to do that. And this is one way of looking at it from the digitization point of view of being able to do that. An alternative is the ability to be able to get in financial statements directly from an organization's accounting system. So what we have here, various accounting systems, Microsoft Dynamics, Peachtree, Small, Sage, Xero, be able to import that in directly into your credit decisioning system. Now, the benefits with this is you get the latest data in terms of the financial data, but you also get other benefits from the point of view of the ability to see what's actually going on with those financials, not just the ability to see, income statement, balance sheet. You're actually having a closer look and going, hang on a sec, how is this organization managing its financials? And even relatively small organizations, especially when you look at something like Sage or Xero accounting, QuickBooks, relatively small organizations will have an accounting system of some sort. So being able to link that in, take away the pain of them having to provide financials, take that pain away completely, and give you the benefit of getting that data quickly. That's one of the items you can look at from it, gathering that financial data as such. Continuous gathering of the data without any input. So as you get the data in, the person doesn't have to do anything. It comes in automatically. And that's the kind of thing you want to be looking for. That is painless from the point of view of the user. And obviously from your point of view, it gives you a lot of benefit in terms of being able to get to know your clients better, both from the point of view of decision making. So the next time they apply for a credit product, you already know from the point of view of their process, that's easy to expedite the time to money in that case. Bringing it in, being able to get it out of those accounting packages, get the financial statement import done, and even you can extend, if you're looking further down, if there are covenants associated with this, the automated monitoring of that. There is multitudes of benefits being able to get this kind of thing in and then applying it to your credit decisioning process. I spoke very quickly. I apologize. I a lot of information to get across. So thank you very much. I hope that was interesting. And let me hand back to my co-presenters.
Yes, thank you very much, Nelson and Helen. Yes, now we have time for questions. I do encourage our attendees, please type your questions if you have ones into the chat, and we will read and answer them right now. So this is the moment. I do have several questions to you from my side. So the first one, because we are tracking on what is going on with the digitalization year by year for the SMEs here in the region. And my first question to you is, so you both mentioned challenges that banks are facing. when digitalizing, or why they're not digitalizing, because of old core systems. So also not centralized data that you also mentioned, and also, as it was in my examples, that even if some banks have all the data on the company, including invoices, including accounting, including everything, still this decision making is not automated till the very end, and still customer has to provide some data, though the banks has it all, let's say. So what do you say, what do you choose as the main challenges from your experience, and what how to overcome them? Because we do see that despite of the challenges, banks digitalizing.
I think from my observation, yes, despite the silo systems and the legacy system, there's definitely a drive, a need, and I think that the banks are recognizing that they can't keep it's not sustainable to continue with these legacy systems.
Mm-hmm.
And I think the COVID pandemic has actually pushed them to I guess evolve from like having a nice feature to their system to becoming actually this is something that we must do. So I think the choice is becoming like not an option for them to stay with their legacy system. And we've
Mm-hmm.
seen that especially in the last few months as well, as people trying to transform and go into the future for banking and compete. They're recognizing that they just can't, it's not sustainable. So they have to make that investment and move from the legacy system to really stay resilient. So, yeah.
Nelson, would you add something here?
I'd agree. I mean, part of the problem is that organizations recognize the problems. They know the problems are there. Things like silos of data, even something as simple as a client that goes from SME to mid-market, where they move portfolios. That in itself can result in a client having to almost re-qualify
Mm-hmm.
in it. That the organizations recognize these issues, but the inertia to be able to change them is quite something. Both from the
Mm-hmm.
point of view of inertia from being able to wanting to do it, and the inertia of the cost.
Yeah.
In some cases, these, especially the larger, the more established organizations, may be a merger of two or three organizations. They might have. It becomes quite an undertaking. I mean, a question for a client is often, do you have a single customer number? And that simple question can often be quite a difficult question to answer. That no, we don't. We've got three numbers because we've got three different systems, and they each have a number.
Mm-hmm.
That can be quite difficult. So
Mm-hmm.
it's tricky from an organization's point of view. I'm talking about a larger organization or a more established organization where that can be. So then to overcome that inertia and also the cost becomes an issue. COVID has expedited that. COVID has gone, we have to do this now. We have to change. And it's provided the impetus for these organizations to do that, partially because of the challenger organizations that have come in, the fintechs, because they're much nimbler. They're able to do their product quicker and get to market quicker. They're able to make decisions quicker.
Mm-hmm.
So in a way, that's also spurred the organizations themselves to do that.
Mm-hmm.
And that in a way is a good thing, because it's renovated the internals of the organization, and for more senior management as well to go, what, we need to do this. It's COVID has given us the change in society and change in organization to do it.
Yeah. What is, in your opinion, what is actually the cost for the bank to move from the traditional lending process to the digital one, or to create maybe some digital process for micros, if, for example, it hadn't existed previously, in terms of also time and people, from your experience?
That's the saying. It's trying to ask me how long is a piece of string. That really depends on the starting point. So an organization, if the organization, personal experience with various entities, you can. So a great example is, especially on the SME side, there tends to be volume. So depending on the if you like, the internals to the bank, how the bank has operated previously, it can be relatively affordable because they're really just renovating the front end of their system. So they're going onboarding, they're putting out a website, they're putting out a portal, the client can upload to the portal, and then it goes into the back process, which is already quite efficient. Or they quite literally have green screens and they've got a lot of Excel, they've got a lot of they've got a lot of email going around. That gets expensive because now you're not just renovating the front end of the organization. You now process data, all of it gets renovated, and that can be it's a multi-year process, and that gets very, very expensive.
Yeah. I agree with you because actually this is what we see here in the Central Eastern Europe. If to count this, 2 years of lockdowns, let's say, and what we see now kind of year by year changes in sense of how many banks are implementing digital processes for the SMEs. And this is a number on the level kind of 3-4 organizations a year from around 100 in the region. So this is like the speed. Of course, we have a pool of the banks here in the region, and the biggest number is in Poland that has digitalized these processes before or started much earlier than lockdowns and the COVID started, and they had a main part of the process digitalized. So these 2 years, only there was kind of improvements and smooth making the process smooth, etc. But the changes year by year is kind of, as I say, 3-4 organizations. My question to you is, what do you see as a next accelerator or the next thing that will fasten the digitalization in SME sector?
Well, it's hard to pinpoint a particular feature, but I guess the thing is, what I see, all the user-friendly capabilities and the features you're experiencing for personal banking will definitely enhance, and the drive for the digital features to go into the SME, the micro SMEs. I mean, for example, I have a SME business bank account, and for me to open a business bank account, it took me 5 minutes on my mobile phone. That was it. It was really quick, and that type of features was a year ago, and I would say that's going to have a knock-on effect to the SME market, and then the micro SMEs, and then go upwards in terms of the lending size. But the consumers and the retail space is driving that demand because everyone is getting used to that more user-friendly capabilities. And I would say whatever features coming out of the personal will keep driving the forces for the SME market.
Yeah. We are starting expecting the same user experience which we have as individuals, right?
Yeah.
Yes, and the younger SMEs are becoming, as an average age of entrepreneurs, the more these expectations are rising.
Yes.
Yes. And what we actually also noticed for the last 2 years here in the region is that SMEs really started to expect from the banks to have, what banks are calling value-added services, kind of e-invoicing, online accounting, DFM solutions. But invoicing, for example, first, of course, is becoming obligatory in Europe, year by year. And second, this is actually the daily business of SMEs, which they would like to automate or make it faster as well, because the main banking operations, for example, the banking transfers in local currency, in foreign currencies, the account histories, etc. This was implemented by the main number of the banks. So this is not the differentiated banks anymore. This is already digitalized and available in online or mobile banking. And this next functionality is actually making the difference and making SMEs choose the bank which is offering the bigger number of functions, let's say.
I'd agree. Yeah, I'd agree with that. I mean,
Sure.
you're starting to see it's, and it also you've got to be discriminate between your smaller SMEs, so the micro SMEs where it's more retail, and you're able to offer those those specific personalized services. But when you start to look at the larger SMEs, there's cases where organizations like financial institutions will provide accounting packages. And part of the sign up is you get an accounting package. The benefit to the lender is that you've already got an existing integration, you've already got that financial data, and from the benefit for the SME is, well, you've got an accounting package. That's one expense you don't have to worry about.
Exactly.
It also then has the aid of quicker decision making. Seeing your financials, know your financials, great. You want an overdraft? Excellent. We don't even have a person to do that. The system will just give you the overdraft that's pre-agreed. So it is an expansion of that. And even the traditional organizations are able to do that. Now, the fintechs might be more specific. The traditional organizations, they can expand their services to cover things like personal finance, leasing, whatever. A much wider range of services can be provided. So I think that's what's going to drive it is it's a combination of, I think, regulatory pressure to an extent, depending on how the regulators deal with it, and also competition. Seen it in other markets where the competition has driven innovation. It's forced the larger entities to become more flexible in terms of how they offer, what they offer changed, and they've had to renovate their internals to be able to support that. And that's been good for the market, and it's been good for them because they've got more efficient at what they do. So it's not all upside, but they're really, if you look at some of the other markets that I've dealt with, that has been the major drivers for that.
I agree. This is actually the reason why I chose one of the Polish banks, just because they offered invoicing and accounting for me. This was a differentiator. So we have one question from Stefan, which I will read right now. So how much would you agree or consider that DFS processes are dependent by central banks' understanding and support, for example, avoiding that these national regulators are becoming potential bottlenecks?
Well, it's not all, again, this is not all downside, because if you look at our regulators now, I can talk from the UK's perspective, because they've been quite innovative in terms of the way they dealt with it. So in the UK's perspective, going back 5 or 6 years, when they started with the challenger banks, there hadn't been a new bank license issued in the UK for decades. I mean, quite literally going back like 100 years. And they made the process of registering as a bank, as a digital bank, easier. They also made it easier from the point of view of once the bank gets the process to get that banking license was made easier. And then post that, to get up on your feet, to make you competitive with the larger organizations. And that, in that case, the regulators actually promoted it. Now, the converse to that is, that's when the regulation comes in. And then you're starting to put KYC, AML. There's all sorts of areas that can be an impotent, like you say, with a bottleneck. They can strangle that too. So it's it's almost a case of give with the left hand, take with the right hand. They can promote the fintech challenger bank situation, which is exactly what the UK did. Hence why there's quite a vast array now of the famous one being Revolut, a unicorn, worth a billion pounds and the like. It's quite remarkable how it can benefit it. But yes, there is the onerous nature of the regulation, and then you start to become subject to Basel III and Basel IV, and then there's all of the other components to it that come into it. So, can they be a bottleneck? Yes. But can they promote it? Yes. It just depends on how they see the benefits that they're going to derive from it, I think.
Thank you very much, Nelson and Helen. Thank you very much. We'll be closing the webinar. So we are run of the questions, and actually, yes, run of time. So thank you, everybody. Thank you, attendees. for staying to the very end and active participation. Thank you, Nelson, Helen. Thank you, everybody who joined today, and see you next time online during our webinars. Thank you and goodbye.
Thank you very much.